Okay, you're live.
Hello, everyone. My name is Tiernan from Tiernan Associates, and I come to you from, well, my office is in Union, and I just happen to be in Troy, Ohio at the moment, but my office is in Union, Ohio, and I appreciate everyone for watching me this evening or whenever they may watch me in the future, but I'd like to thank Diane for allowing me to do this evening. And what we're going to talk to you tonight about is some things you need to keep track of, some things you don't need to keep track of, some recruiting tools, and things that I truly believe that will help your business, maybe make your business a little bit easier. 2 minutes about Tiernan and Associates. This is, I'm very proud to say, our 40th year in business, second generation business. My father created it in 1980, and at that time I was in not preschool, but I was pretty young at the time, an after school program. The person that was one of my teachers, well, she happened to be in what business? She was actually in your business. She was in Mary Kay, and she was a director for many, many, many years. She's actually still active in the business. And that's where we all began. So he started in 80 with that one person, and we've just grown since then. And over those 40 years of doing tax returns, we've probably processed 100,000 Mary Kay returns. So when I talk to you tonight about some things you need to keep track of, not to keep track of, some recruiting tools, maybe what you shouldn't do, should do, it's not only based on my 26 years of being in business and doing this, and it's not only based upon the hours I spent in classrooms and periodicals and all that fun things that you can imagine. But what really separates us from other tax services is the fact that we, as I'm sure you can imagine, if you've processed as many returns as we process for as long as we process them, we've had to deal with what governmental entity at one point in time? Well, all of our friends, can you imagine? It would be the IRS, of course. So when I suggest for you to do something or not to do it, it's not just, again, based on what I've read, what classroom I've been in, but it's that one-on-one time that I've had specifically with the IRS, whether I'm sitting across the table from one, or I'm talking to one in maybe Florida or Washington. So that's really what separates us. We've got that one-on-one time with the government specifically regarding your business, and that's what's really different about Tiernan Associates. So as I mentioned a moment ago, I've been doing this for the last 26 years. I took over the business from my father in 2006. So we've got a lot of time, a lot of experience doing tax returns, again, specifically for you folks. So where I'd like to start, as I've started so many times before, is some things you need to keep track of. Now, specifically regarding Section 1 items, of course, you got to keep track of your sales. But I'm going to talk about 5 other things you need to keep track of. Now, first one item is personal use. We're all going to have some kind of personal use. So that's the first time you need to keep track of. And then the second item that you need to keep track of is gifts of Section 1. Now, when I talk about gifts of Section 1, I'm talking about the whole Section 1 item. A lot of people will want to say, well, if I discount it, that's kind of a gift. No, keep in mind that if you're giving a gift, it's the entire lotion, it's the entire lipstick, it's that full, complete item of Section 1. Now, when it comes to gifts, there is a limitation there. It's a limitation that's existed for many, many years. And that limitation is $25 per person per year wholesale. $25 per person per year wholesale. And as many people may suggest, or at least think, that's not a lot, and I would agree with that. However, of all the years we've been doing this, it's never been an issue if you happen to give that one particular good customer $69, $89 worth of free product. However, who do we have a tendency to give away a lot of free product to? That would be our mothers and our sisters and maybe close friends, and we want to give $500 wholesale to somebody. That's not going to work. So what you want to make sure that you do is don't give away the store to one person, such as mom and sisters. If you happen to give, again, a little bit more than $25, $65, $80, it's not an issue. but don't give away the store to that one person. And that again is what? Is that $25 wholesale or retail? Wholesale. Wholesale. The next item I want to address, next time you need to keep track of, is your hostesses. Then after that, we've got demos. And then the next item I want to talk about is donations. Donations. Now, when I talk about donations, what I'm talking about is, let's say, for example, you've got something that's on your shelf. It's been sitting on the shelf, and for whatever reason, you couldn't sell it. Maybe you didn't think that to donate it or to hostess it or whatever. And now you've got an item that may be expired, close to expiring, whatever the scenario is. Get it off your shelf. And this is one easy way and deductible way of doing that, is to donate it to a charitable organization. Now, if you donate it to a charitable organization, what you need to do is keep a list of those items that were donated and get something with the charitable organization's letterhead saying thank you for the Mary Kay product donated. Easy peasy. Very simple. Now, you take that list of items that you donated along with their letterhead on it, you staple it together, and that will work. And there's no limitation on this. So again, if you've got stuff that's on your shelf, get rid of it. Let it go away. You don't want to collect that on your return. You don't want to collect that on your shelf, excuse me, because it's not having any positive impact. So what happens if you do have something that is expired? What if you've got something on your shelf that you do not want to give to that person you don't like, that mother-in-law you don't care for, whomever? Give it, gift it to a funeral home. Gift it to a funeral home. You say, oh, why a funeral home? Here's the reason I say never throw it away. If you throw something away, will you ever have any potential sales from that product that you gifted or donated? Absolutely not. So my point is that if you gift it to a funeral home, you are limited to $25 per funeral home because they are a for-profit entity. But if you gift it to them, is there possible future sale because of that? Absolutely. Funeral homes have to get cosmetics somewhere as well, correct? So to me, throwing away the product on your tax return has the same value as a gift or donation. You still get it as a deduction, but there's no future possibility of any sales from that throwing it away. So that's why I'm suggesting donate it, gift it to the funeral home. Somebody will want to use that. Now, if you do have something with SPF, sunscreen's probably not going to go very far at the funeral home. But if you've got something else, any type of colored item, gift it to the funeral home. I'm certain that they'll take it. So keep that in mind. Try not to throw it away. Now, one item that Diane did address, because I'm not familiar with this particular webinar system software, is that if you do have questions, feel free to ask those questions if you wish throughout the webinar, and I will do my best to get to those. However, if there are questions that you have and that for whatever reason you do not want to address it this evening, you don't want to leave it on a group chat, then just simply feel free to email me or give my office a call, and I'll be more than happy to do that. Now, what I will try to do, not familiar with the software, but I will try to type that information in, and I do believe it'll appear up. I'll give you my phone number and my email address. So where we were those 5 things that you need to keep track of. And of those things, do you want to account for them as retail or wholesale? Again, we want to account for those as wholesale items. Wholesale. Very important there. Don't want to put retail. That would definitely interrupt things. The next area I want to talk about is something that we should have done a couple months ago. Not a couple, excuse me, last month. Something that we should have done last month, December 31st. What is it that we should have all done on December 31st of last year or January 1st? Ending inventory. The not very fun thing. The day that we would rather do all sorts of other things other than count our stuff that's on our shelf. So what happens for all of those folks that didn't do it? For those of you, congratulations that you did do it on that day. But for those of you folks who didn't do it on that day, what should you do? Well, the only thing you can do now is go back and try to estimate what you had on that shelf as of December 31st of 2019. How do you go about that? You just simply look at what you got and work with that. That's all you can do. But you do have to come up with something. The IRS is going to tell you to do something. I'm going to tell you to do it. And the corporation is going to tell you to do it. So come up with something to the best of your ability. Now, when it comes to your ending inventory, oftentimes it's an issue. The first item is we don't do it on the correct date. Again, got to go back and estimate that. The other issue that we have is trying to locate all of our product. For a lot of folks, they may have it in this room or that room, maybe out in the car, maybe at mom's. So you got to make sure you account for all of it. The other issue with ending inventory is what happens if with your kit you got some free product in that kit. What happens? Maybe you've won some product from your director. Maybe a sister consultant, for whatever reason, had to get out of the business and she gave you some free product. What do you do with the free product that you get from the company or from whomever? What do you do with that? Do you account for it as part of your inventory? No, you do not. If you got it for free, then it just simply goes nowhere. If you gift it, you don't account for it as a gift or a demo or a hostess. It just simply goes away. The only time that you're going to account for anything is when you sell it. But it's my opinion is to not sell that product that you've gotten for free from whomever. It's my opinion that instead of selling it, give it away. Give it away as advertising. So just some food for thought there. But I do not want to know anything about any free product that you receive unless it's sold. Unless it's sold. So when it comes to your ending inventory, there's quite a few issues there. But the other issue, as I addressed just a moment ago, you always want to make sure you account for it in wholesale. So I had a client in my office today. She happened to be in your business and he was a plumber. And they're asking me, why do I have to account for my ending inventory? What does it matter? Well, the reason that you have to account for your ending inventory is it determines how much you make on that product. Who cares, right? Do you really care that you make 41% on the items that you sell? No. Well, why do we do all of this stuff anyways? Because of the IRS. And that is the purpose for ending inventory, is it determines how much you sell as a percentage. Now, what's the most you can make for every item that you sell? As a percentage, it is 50%. But for a lot of you, you don't sell for 50%. Most of you sell for 41, 42, 43 with gifts and such, discounts. That's what's normal. Now, here's one huge advantage of dealing with Tiernans. We know that you have to do your ending inventory, of course. But one of the advantages of dealing with Tiernans is this, is that when we review your information, your ending inventory, for example, and if the numbers do not come out as they should, then we're going to ask, what do you mean that they come out as they shouldn't? What could be possibly wrong? Well, what we've found in the last 40 years of doing this is oftentimes ending inventory numbers can be off because of those various reasons that I just given you. So if we look at your return and the numbers come out that you've only made 2%, we're going to ask. We've done returns in the past where they came out with negative percent. That means that you made absolutely no money and gave people money to take it away. Of course, it's not possible at all. Then the opposite spectrum of that is where you're making 80% on every item that you're selling. Well, we know that's not true either. So when we do the return, when we look at your ending inventory, for example, we determine, do these numbers make sense? If they don't, what are we going to do? Well, we're going to contact you. We're going to email you. We're going to call you. we're going to do something that can make sure that the numbers are correct, or at least as correct as possible. Huge advantage of dealing with Tiernans, because oftentimes these numbers aren't always correct. So if you are doing it yourself, or if you've got an account that's nowhere near as familiar with your business as what we are, they won't ask the questions that we will ask to make sure that the numbers are as correct as possible, because ultimately, who's responsible for your return? You are. So we want to make sure with Tiernans that we help you, guide you, and do the best that we can for you, but also to make sure that the return is as correct as possible. Very, very important. So we help you with your ending inventory. We do. We call you up. We ask, is it possible that you may have another $500 of purchases? Or maybe did you have $1,000 more in gifts and hostesses? Oftentimes, we talk to our clients and we'll come up with something that will fit as it should. Huge advantage of dealing with Tiernans. Very, very big deal there. Next here I'll talk about is when it comes to any business, they always have sales of some kind, and you folks are no different. So when it comes to sales, let's say, for example, that you've got something that you could sell for $10. You don't sell it for $10. You sell it for $8. What number do we want? We want the $8. What happens to the $2 that you lost out on for discounting? It just simply goes away. As I mentioned a little bit ago, it is not a hostess. It is not a gift. Discounts are just simply money you do not want to collect on. And they are not an expense. That's very, very important to understand. Discounts are not an expense. So tax-wise, think about this for a moment. I'm not looking at it from a marketing perspective, just from tax-wise. It would be better if you gave a gift, to give a gift of $2, a gift of $2. So instead of giving the discount for $2, do a gift with purchase. That way, that $2 that you gave, you collected the full 10, but you gave a $2 section one item, a brush or whatever, then that's an expense to you. So at least consider it. Now, if you've got clients that absolutely insist upon having discounts, then of course, don't hurt your business because of this, but just some food for thought relating to your taxes. The next area that you're going to have when it comes to income is your commissions. So you got sales and you got commissions. Now, here's very important. If you don't have Tiernans do this, if you pay another accounting firm to do this, make sure that they're aware, that they understand. And not only do you have commissions coming from Dallas, but you also have sales. I've found within the last 5 or 6 years that there's a lot of accountants that do not realize that you've got commissions plus sales. The commissions show up on the return, but the sales do not. And there have been more than one situation over the last 5 or 6 years that we've looked at prior year returns for new clients and realized there was no sales on their return, just commissions. And again, as I mentioned a few moments ago, ultimately, who's responsible for your return? You are. So you gotta make sure that this gets in there correctly. So when it comes to commissions, I've seen a 19 commission 1099 just today. So I know the 1099 miscellaneous has been mailed out, and that was mailed. But in addition to the 1099, you get it, but who else gets that 1099? Well, the IRS gets that 1099. So if you get this, they get it. What does that mean for you? That means you have to file. It's very important. Because if you don't include that on a return, what are you going to end up with? Not an audit. You will not get an audit, but you will get a letter from the IRS, and we don't want that. So if you get a 1099 from the company, that means that you must include it on your return. So then who has to file a Mary Kay tax return? Who has to file? As I just mentioned, if you get a 1099, but what if you didn't get a 1099? Who has to file? if you sell any Section 1 item for more than what you paid for it, did you sell it for more than what you paid for it? If you did, you have to file. If you bought something for $5 and sold it for 10, have to file. Now, a lot of people will say, well, I only sold $200. I only sold $300, $400. I'm just not really interested in that. And I get that, okay? There would actually be very little tax consequences included with that. But here's what you also have to consider is not only what you made, but also take into consideration how much you've spent. If you've got a full store, if you've got $3,000 wholesale, if you went and purchased preferred customer program and you've got Section 2 and you've got shipping, you've got mileage, you went to some meetings, you've got some expenses for this. And if you don't account for it in the year that you purchased it, what happens to those expenses? They just simply go away. They go away. So what you want to consider again is not just what you sold, how much you spent. So if you've got $3,000 in wholesale on your shelf, and as a result, you decide not to file anything, what happens to that $3,000? It just simply goes away. It goes away. So consider that if you either yourself or you've got a sister consultant that's not really interested in dealing with taxes, how much does she have on her shelf? How much has she spent this year? And if she doesn't account for it in 19, it's just gone. So to me, that's kind of a big deal. Now, I will have people that I just had someone on social media talking about how she didn't really sell anything in the business. She has no inventory. And I got the impression she just really wasn't interested in filing. And if that's what she did, and if that's reality, if she didn't really sell very much, and at the same time, she doesn't have much of an inventory, she should still technically file, but I'm not trying to convince her to file because she just gave me the impression she just wasn't really interested. And if that's your situation, of course, by all means, that ultimately, again, you're responsible. But if you spend any money and you don't account for it, then it's just lost. So some food for thought there as well. That's income for you folks, and that's who has to file. The next term I'll talk about is typically the worst part of any business, no matter whether you're this big or this big, is what? It's bookkeeping. No one likes to bookkeep, right? Especially from what I understand from the last 26 years of dealing with you folks, is most of you don't like to do bookkeeping. So there's two extremes when it comes to bookkeeping. Doing what? Nothing. And the opposite extremes is what I've referred to for years as charts and graphs. So you either do nothing, as in doesn't even include a Nike box, a shoe box, a Reebok box, no boxes at all. And then the opposite extreme is charts and graphs and where you're spending too much time with your bookkeeping. So where's the happy medium with this? Well, what we've devised many years ago is this expanded filing system. Something that is not very complicated, something that's very user-friendly. And if you'll notice, there's tabs that have already been created for you, and it's already done for you. So how does this work? This doesn't involve a box, and it does not involve software. All this is you just simply take that receipt that you may end up with, whether you're trying to recruit somebody or whether you went and got some products, some office supplies at a Walmart or wherever, and you take those receipts and you put that under supplies. If you're trying to recruit somebody, you put that under meals. So what happens to the receipts when they end up in the expandable filing system? They do not end up lost. They do not end up in your purse or in the console of your car. They end up in a nice, tidy, expandable filing system where the receipts are not lost. Very user-friendly here. A place where they don't end up on the dining room table this time of the year. When people have a tendency to do their bookkeeping for the year, this is when they would do it. Don't have to worry about the dining room table, the dogs, the cats, the kids, all that stuff. It's already included. It's already in here. It's already separated. So this time of the year, what you do is you take the receipts out of the different categories and you add them up. Now, what do you add them up on? Not a phone. You add them up on an adding machine. Why an adding machine? Because it's got that tape at the top, right, that you tear off. A lot of people ask, well, what about software? Well, the problem with software, in my opinion, with Excel as an example, is it can be skewed. The cells can be skewed easily. Adding machine numbers can also be skewed. However, they can be transposed, but unlikely. You can always check that. The thing with software that you have to remember is this. You got to make sure that the information that goes in is correct. So here's one common example of where software, in my opinion, is not the best. What happens if you've got something that's on your shelf and you take it off for a demo? You take it off as a hostess. You take it off as a gift. What I have seen, especially within the last decade with the advent of more and more software, people using more and more software, is every time any Section 1 item leaves that shelf, it is then considered as a sale. Is that correct? Absolutely not. Those items are not sale items. So every time those leave the shelf, they're considered not a sale item, but the software identifies them as a sale item. So what happens to your sales when this occurs? Your sales are drastically overstated that I've seen in the last decade. And I mean drastically, by thousands of dollars. So is that good? Absolutely not. Another huge advantage of dealing with Tiernans is that if we find, going back to that percentage, remember that percentage, how much can you possibly make for every item that you sell? 50%, but you don't sell for 50%, maybe 40, 42. Remember me discussing that a few moments ago? Your sales is a part of that. So we've asked people about their ending inventory and they'll say, no, my ending inventory is correct. I know it's correct. So then what do we ask about? We ask about their sales. Then we ask, is it possible your sales are overstated? I ask my clients, go back through the actual invoices and double check those. Make sure that your personal use is not a sale and your gifts and your hostesses are not sales. So they'll do that. Ask that several times. Oftentimes they are overstated. This past year, I think that we had a person that their sales were $7,000 overstated. What does that do to your tax return? That means you have to pay sales on $7,000 worth of product. That's not good, is it? Huge advantage of dealing with Tiernans again is we look for these things. If the numbers don't work out, we're going to ask you. So when it comes to software, it's imperative that you put it in correct, because if not, that could cost you money. To me, I understand when it comes to sales, it tracks what your customer buys from you and it counts, and it's very simple. However, at least based on my opinion, when you account for your sales, print out the invoices and keep those, and you'll say, oh my goodness, that's a lot of paper. Yes, but just to verify that it's done correctly, that's what I would suggest that you do. Just print out your invoices, print them out, and then add them up. You can go by with what the software spits out, but I've seen way too many times it's not correct. If you look at the individual invoice, you'll be able to determine how much of that invoice may have been a gift or how much is a hostess. If you decide not to print all the invoices out, I get that, but at least review the software to make sure you think it's correct. Very important. So that's how to bookkeep. In my opinion, our expandable filing system is easy peasy. No software, no nothing. Just an adding machine in this. And again, all you do at the end of the year, you add up separate categories with an adding machine, boom, it's all done for you. Very user-friendly. And who likes it like this? Where do we get this idea? From the IRS. So take that for whatever it's worth for you. Just, again, Just some food for thought. Next area I want to talk about is usually the largest expense on most of your returns, other than your Section 1 purchases, is, what would that be? That would be your mileage. Mileage. For 2019, it's worth 58 cents for every mile that you drive. Wow, it's never been that large, folks. In fact, for 2020, it went down half a penny. All right, it went down a penny. 57 and a half. There we go. 57 and a half for 2020. 58 cents for every mile that you drive in 19. What does that encompass? That's your mileage, that's your insurance, that's your car payments, all that stuff, maintenance. You don't have to keep track of any of your fuel receipts. So if you are a consultant and you just got into business in October and you've been keeping all of your fuel receipts, throw them away. Doesn't have any impact. Now, if you are a premier, if you're in one of the premier levels and above, got to keep track of all of that. Now, I won't go into detail about that. I've left my information on the chat box. So if you have any questions regarding that, feel free to call or email me. But again, if you are a consultant or a director, not at the premier level, you keep track of just your mileage, no fuel receipts. So for 58 cents for every mile that you drive, again, you're going to get your fuel, your insurance, your repairs, and maintenance. How do you go about doing this? Well, we've had this for years. This is our mileage log. It's very old school. I get that. For a lot of you folks out there, you're going to use an app, and that's fine. I have no problem with the apps, but just make sure that if you use an app, you have the ability to print the app out. Very, very important. So when it comes to keeping track of your mileage, you just simply round up or down if you're going to write it. And you just, whether you're delivering a product, whether you're going to a career conference, whether you're driving to Dallas, whatever the situation is, you just keep track of that. It's not an issue. Now, one very, very important item regarding this. As I just mentioned a moment ago, you're not going to get any credit for any maintenance. But what you have to make sure that you do is you keep track of the receipts for your maintenance. Okay, you just said I don't get any credit for tires rotated, brand new tires, brakes. I get no credit for that. Well, why do I need to keep the receipt? Because every time you get a receipt for maintenance on your vehicle, it's got your odometer reading. So it's imperative you keep at least 2 of these a year. Why do I need an odometer reading? It verifies that you drove the vehicle. Many, many years ago, I had a client that the spouse took meticulous records of the vehicle. He was a mechanic. They were audited for 2 years. In 2 years, they got no mileage deduction for that. But he had the records. He had all the records for when it was maintained, and she had an excellent mileage log. She got no deduction because it wasn't done by a third party. So it's very, very important that you have something done by a third party. You say, well, my spouse insists on having it done. Well, in this case, go out and get a cheap oil change, or just go to a dealership and ask them to read your odometer reading. Whatever, it's got to be done by a third party. It has to. If you do not have these, you have no mileage. So got to get those. But that's car and truck. Huge deduction there. Next one I'm talking about is technology. Technology. To me, in this case, this is a recruiting tool. You're going to be sitting somebody across the table from somebody at where you would go. Panera Bread is the example that I use all the time. So you go to a Panera and you're trying to recruit somebody. And that person's going to have in their hand, in their purse, on the table, somewhere, their phone. And now, because they're in your business, now maybe a portion of that phone can be deductible. To me, this is a recruiting tool. Why is this a recruiting tool? Because they're going to have to pay for that phone anyway, aren't they? And now because they're in your business, maybe a portion of that can be an expense to them. That to me sounds like a great recruiting tool. Same thing for the internet. Now, because they are in your business, now they can get a portion of that internet on their tax return as an expense because they are in your business. Sounds great. Now, what are some details behind this, though? Can they have 100% of this? No, they can't have 100%. What can they have? Maybe they could have up to 70%. Up to 70%. Based on my audit experience, I wouldn't suggest anything more than 70. But with that is maybe they only use their phone 20% or their internet 20%. Is that better than no percent? Absolutely. So huge advantage of being in your business is now things that you're going to have to spend money on, now it's going to be deductible. Maybe not 100%, but something is still better than nothing. So if you've got somebody that is sitting across the table from you and they say, well, I'm thinking about getting into this, that to me is a recruiting tool. Ask them, would you like to be able to write off some of your cell phones, some of your internet? So here's how you go about doing that. If you've got somebody has a cell phone bill like pretty much everybody does, but the question is who's on the cell phone bill? Because you can only take their part of that cell phone. So you get the cell phone bill, you look for their specific cell phone number, and that is the only part of that bill you're going to be able to take. Only part of that bill. So if that person isn't the primary person on that bill, maybe it's a secondary person that might cost $25, and you're going to get a percentage of that $25. But if you're the main person on that bill, maybe the primary person on that bill is $90, then you're going to get 30% of that primary. So my point here is maybe consider moving who the primary person is on that bill. The primary person is going to get more bang for the buck if they're the primary than just simply a secondary person. But we can only take a portion of just that person's cell phone. Not of the whole bill, just that specific person. Now, when it comes to the internet, for some folks anymore, they don't bundle their internet. All it is just simply the internet itself. But if you do have where you've bundled the internet with maybe a home phone, maybe with cable, I just want what is on the internet. Nothing more, just the internet. Now, when it comes to that bill, here's the thing. I just want a percentage of it. Can't get all of it. Just like I mentioned with the cell phone, no more than 70%, no more than 70% of that. But still, something is better than nothing. I think it's a great recruiting tool. So technology, I'm not talking about just cell phones as well. I'm talking about laptops, what I'm talking on now, computers, things of that nature. That can be deductible if you're active in this business. And what I mean by active is that you have to be earning income. There has to be some income being generated here. You certainly cannot write off your cell phone bill for the year. For the entire year of 2019, you made $200. Just think of it like this. The more money you make, the more things you can have. The more money you make, the more things you can have. It's a wonderful concept and does very well specifically in your business. Next thing I want to talk about is how to take a business trip. To me, this is another recruiting tool. How to take a business trip. Now, let's say, for example, that you've got somebody who's in the desert Southwest, maybe a friend, maybe a sister-in-law. And this time of the year, if you live in the Northeast, that's a great place to go and visit, isn't it? Absolutely. So you got your sister-in-law that lives in Mesa. And you talk to your sister-in-law and you say, maybe I can go out there, maybe I can do some business and I can visit. The primary purpose being to make money, though. So as a result, she gives you 20 different emails. So what you do is that you have to fulfill the intent to do business before you do business. That is the first piece of this. You have to have the intent to do business before you do business. So what you do is you get 20 of these emails, you send them out. Of these 20 people that you send the emails to, included in that is going to be, we're going to have a great time. There's going to be gifts, there's going to be food, all that stuff that we're all familiar with, right? So of those 20 people, 15 people show up. Now, of those 15 people that show up to your party, that's in Mesa, Arizona, they have to buy and or recruit. You have to do something. Because if you make no money from that trip, what do you have? Do you have a vacation or do you have a business trip? You've got a vacation. So you have to look at it like this, is that when you go, you are going there as a business, just like as if you were going to go there for your W-2 job. Your supervisor, your manager that would send you to Mesa would say, you have to generate income for this business, and you have to have that same mentality with your own business, that you're going to Mesa not to visit friends or family, but you are going there to make money or recruit. Because if you don't, then you got a vacation. But let's say you jump through the hoops and you're there for a week and you made $350 and maybe you've recruited one person. You've fulfilled the obligations to do it. And what are you now going to get? You're going to get the airfare, you're going to get the hotel stay, you're going to get meals, all that stuff, because when you went there, you generated income for your business to justify. And when you're there, you've got to set an itinerary, you've got the email, all of this, but it works. The nice thing about all of this is that you cannot do this with your W-2 job, because you are in your business and you can sell and recruit throughout the country. Huge recruiting tool here. Huge. Now, what if you go to a company-sponsored event? If you go to a company-sponsored event, you have to sell and recruit? No. But for the directors out there that just came back from Orlando, what you want to make sure that you do is that when you're there, that you document what you did when you were there. Because if you're from Boston and the IRS sees, oh, you went to Orlando in January, what are they going to suggest that you did when you were in Orlando? You had a vacation. And you would say, well, it was company sponsored. Yes, but you still have to prove what you did when you were there, and that you just didn't go see Mickey and you just didn't go to Universal, that you actually sat in classes and you learned from others in your industry. So it was an educational purpose that you went there for. So you got to keep that in mind. You got to keep an itinerary of what you did when you're there. Very important. But again, you're going to get the hotel stay and the meals and all that stuff. Very important. Next area I want to allude to for just a moment is office in the home. Office in the home. Another wonderful recruiting, I think, another huge recruiting tool here is office in the home. So how do you start this? You take the square footage of the room, this area that you use specifically for Mary Kay, 365 days a year, and then you take the total square footage of your home or your rental home, apartment. So you take the square footage that you use for your business, then you take the total square footage of your house. Then you end up with a percentage. For most people, they end up with 15, 18%. That's normal. So what are you going to get? You're going to get part of your mortgage interest, part of your property taxes, part of your home insurance, repairs and maintenance on the home. Now, if you rent, you're going to get your renter's insurance. You're going to get your rent that you pay out. All of these things, another huge advantage of being in your business. And the reason that I think it's a huge advantage is, again, people are going to spend money on their home or their apartment. They're going to heat their home or apartment. They're going to insure it. So because they're now in your business, now it can act as a deduction. Huge recruiting tool, again, in my opinion. So all these little pieces, if you're sitting across the table from someone at a Panera or wherever, keep these in mind. Yes, tell them all the benefits of being in the business and so on and so forth. But put the tax aspect in it as well. Maybe it will get that person excited and or their spouse also excited. So some food for thought there. Now, the next area I want to talk about, one that I forgot to mention before, and this is always a topic of confusion, and that is, what do you do? And I'm sorry, I'm backing up here to section 1 items, but what is it that you do with items that the company says that are no longer, that they are on your shelf, the company has discontinued them, but they are still good? What do you do? Do you just simply write them off, take them off the shelf? No, you do not. Consider this for a moment. If you've got a product on your shelf, can you still sell it? Can you discount it? Can you hostess it? Can you gift it, donate it, any of the above? Can you do any of those items? If you can, it's still part of your inventory. The Internal Revenue Service could give two hoots whether Mary Kay says that it was discontinued. They don't care what the company says. The question is, can you still sell it, donate it, gift it, whatever? If you can, then by all means, keep it on your shelf. It does not matter what the company says. So keep that in mind. That's a question I get quite often. Quite often. The product is still good, so keep it on your shelf. So how is it that you work with Tiernan Associates? I've mentioned some of the benefits that we give our clients is that we're constantly looking to make sure that the numbers fit, that you do have some mileage, that you do have some utility expenses. You're going to have some internet. Maybe you're going to have some cell, and that maybe if you didn't tell us, we're going to ask you about it. If you don't put anything for section 2, we're going to ask. For preferred customer, we may ask. So we're constantly looking to make sure not only if the numbers fit, but are they all there? Again, something that I don't think I know you would not get from the franchise folks that are down the street. They're not going to ask these specific questions. So how do you work with Tiernans? What we have is we have this organizer, and it says 2018 on it. The 2019 books are out, but this is our organizer that's been around for 40 years. And in the first half of the book, we ask specific tax questions, generic questions, W-2s, all of that stuff, all the normal tax stuff. Whether you have childcare, whether you have rentals, sold some stock, all that. Then the second half of the book is where we ask you specific business questions regarding your business, whether you sold, Section 1 purchases, ending inventory, preferred customer. We ask all those specific questions for your Mary Kay business, and we ask you to fill that out. Now, if this year there's 26 pages to this book, 26 pages. Some people look at that and say, oh my goodness, that looks intimidating. But we've tried to incorporate 99.9% of the people in this country in this organizer. So if you go through this and you say, well, I don't have a rental, I don't have a farm, I didn't sell any stock, then you just simply move to the next page. That's all there is to it. If you have childcare, you fill that section in. Well, maybe you do have a rental. You fill that section in. So my point is not all 26 pages will allude to you. They don't impact every page of that booklet. So what you do is you take each page by page, and if it doesn't pertain to you, then move on it. But if you do have questions, feel free to give my office a call or email me. We'll be more than happy to help you get through that booklet. So when can you do this? You can do this next week. You can get the information to us. You give us the booklet that I've just shown to you, fill it out to the best of your ability. Any questions, don't hesitate to ask, but you get the booklet to us along with your regular tax information, produced by next week if you wish. Now, ultimately, however, and normal turnaround time toward the beginning of tax season, 7 to 10 days. Later in tax season, maybe we're talking 10 to 12. If it takes longer than that, we should have already contacted you, asked you for more information. Maybe we're missing something. But ultimately, the question is how much? Now, on average, and this would be a taxing state, on average would include your entire personal return, your business return, and your state return. And the federal would include you, your spouse, your W-2 if you have one, your spouse's W-2, your kids, all this stuff, including your business and including a state, whether that's Massachusetts or New York or Pennsylvania, whatever. On average, for all of the above, anywhere from $240 to $270. Now, if you live in a non-taxing state such as Florida or Texas or Washington, then we're talking around $180, $210, $220 on average. Now, if you have another business or if you've got lots of stocks or if you have multiple rentals, well, then the cost will be going up, but we're still exceptionally economical for what we do. We are very economical for what we do. And the thing is this, tonight I'm talking to you about your business, but if you've got questions throughout the entire year, for example, you call and you say, my spouse is retiring July of 2020. How do we deal with that? You call us in July, we can help you with that. You have questions about your teenage son who's going off to college, we'll help you with the information you need for that. If you end up losing a job, God forbid, you're now on unemployment, we'll help you with that. So I'm talking tonight about your business, but with Tiernan's, we encompass all of the above. We encompass all of the above. So if you're trying to help a relative, maybe file some previous year's taxes, or again, sadly, if you've had a relative pass, we can help with that as well. So we're here throughout the entire tax season. This is all that we do. I am not a part-time electrician. You would not want me to do that. I'm not a plumber. I'm not a roofer. Taxes is all that we do. We do not sell investments. We do taxes for the entire year. I have a full-time staff. This is all that we do. So if you want to call us in the middle of tax season, we're there. But unlike a lot of other tax offices, we're also there in the middle of August and November and December. So we're here to help you. Now, one question I get often from folks is, how can I save money? How can I pay the least amount of tax and for most taxpayers with the least amount of effort? So here's a quick piece of advice. If you or your spouse have any type of retirement plans, max that out as much as you financially can afford with your employer, whether that's a 401k or if that's a 403b, or if you have simple plans with your employer, put as much into those plans as you financially can afford. I'll leave that at that, but that's one really simple, real quick piece of tax saving advice there. But again, if you've got questions throughout the year, don't hesitate to ask. We do ask you to purchase this organizer. This is $5. Once you become our client, it's free to you from that point on. And you say, well, I don't know if I'm really interested in dealing with Tiernan's. Well, here's my suggestion. At least buy the organizer. At least buy that. That's $5. It includes all of those things you could possibly have with your Mary Kay business. But if you go through it, I can assure you, once you go through that, you'll probably want us to help you with your taxes. And again, we're not very expensive. Are we more than the do-it-yourself tax worse-off programs? Yes. You may pay $140 for those once you get done filing the federal, state, and e-filing those. But the thing is that's kind of important, I think very important, is that if there's something missing, if we think that there's numbers askew, if they're not right, we're going to ask. I took an email this past week saying, I'm trying to figure out office in the home, but the software won't let me file an office in the home. Well, that's because you probably didn't check a box correctly. If we think there's an issue with the office in the home, we're not going to ask you to fill out a box. We're going to actually ask you the question, either via phone or email, but we're going to ask the question, something that the do-it-yourself tax worse-off programs cannot do for you. So again, if you've got questions regarding your tax return, regarding retirement, regarding your kids' college, any of the above, you don't need to hesitate. Go ahead and ask. We'll be more than happy to help you. If you are considering Tiernan's, but at the same time, you're not sure about prior year's returns, if you want me to review last year's return, I'll be more than happy to do that. In fact, I just did that for a director out of Maryland just today. One of the issues that I found on her 18 return is that she ended up with an almost over a $17,000 loss in her MK business last year. And folks, that's just not recommended. She drove, per the return, she had drove a lot of mileage that I don't know after talking to her that she could justify. That return probably would have never left my office. So again, we're looking to make sure that we have all the numbers, but at the same time, are they correct? As I mentioned already twice, ultimately you're responsible for your return, so you want to make sure that it's correct. Trust me, folks, you don't want issues with the IRS. It's highly unlikely you ever have an audit with the IRS, but as I mentioned to this lady, she had a $17,000 loss. That little red flag that's about this big for pretty much anyone else in your business went just this little, much higher for her business. So because of that huge loss, something that we're always going to evaluate. We don't want issues with anyone, especially the IRS. So we look out for those. We look out. And if we think there are, we will contact you most definitely if we think there's any issues. Something, again, you're not going to get from the do-it-yourself tax work software programs. As I mentioned, I have the organizer, which I suggest that you purchase. It's $5. How do you purchase this? You just simply contact my office that I have on the chat box there. The next item that I have for purchase is the mileage log that I know a lot of people would say that this is pretty much out of date. But if you're still old fashioned and you still want to write it down, this is $3. And then if you wish to purchase our organizer, very easy peasy, very simple. This is $18 plus shipping. It's very simple, folks. And you'll say, well, I'll just go ahead and I'll do that myself. The chances are you're probably not, and it's already done for you. So very simple. I will leave you for the evening. Again, I hope you folks have enjoyed this. Hopefully it was a little informative. If you have any additional questions, please do not hesitate to email me, call me, and we'll be more than happy to help you not only this time of the year, but throughout the rest of the year. So hopefully everyone has had a wonderful day and it's ended just as wonderful. And have a good evening, everybody. And thank you for attending.